When looking at investing, is it best to go down the direct equity investment path or buying into some sort of collective investment vehicle? Well, Chris Boxall, portfolio manager at Fundamental Asset Management, joins us now with his thoughts. Chris, welcome. I know here we're talking predominantly about small cap stocks, not so much about the blue chip stocks because different dynamics apply to the blue chips. But just broadly, explain the two different investment strategies here.
Yes, as an investor, you have an option to either invest directly in the underlying shares, the underlying equities, or to go via the collective investment route. And when we talk about collectives, we're meaning, as you suggested, a fund of some kind. That's either an open-ended fund, which means a fund that can keep raising new money in perpetuity and is open to new investment, or a closed-ended fund, which many people view as an investment trust. And in the world of smaller quoted companies, and particular AIM companies, we feel there are a great advantage to go down the direct equity route, which we hopefully will cover a little bit more here.
Why is it that what we're talking about now applies more so to smaller companies than to blue chips? I'm thinking mainly because people will say, yes, I've got money in a tracker fund of the FTSE 100. The dynamics don't work the same way, do they, for small caps as they do for blue chips?
No, not at all, not at all. And first of all, you've seen small caps have been huge outperformers over the last few years. And it was very interesting. A survey was put out by a US-based fund management group, which addressed the whole small cap market in the developed world small cap market. And it became apparent, it really drew attention to this outperformance, staggering performance from many companies. And unusually, the UK market was the second best performer. And from the UK market, AIM was the dominant market. So small caps outperform. UK was strong after the NASDAQ. So it was NASDAQ, then UK. And within the UK, AIM was really a dominant market. So how should people perhaps get, our best place to get exposure to AIM and smaller quoted companies? And many people go down the collective route, the fund route, because it's easier. But there are distinct disadvantages. Now, this was perhaps highlighted when the Woodford scandal, when you had a fund holding an open-ended fund, holding a lot of illiquid shares. Some of those were private companies, admittedly, but a lot of them were also quoted on AIM. And it makes it in a rush to exit the fund, the illiquidity of those smaller quoted companies came to the fore, and it really impacted the fund value. So open-ended fund, terrible place to be if you're going to invest in small caps. Why would investors go down that route? And Woodford really shone a light on that. Now, the other route is down the closed-ended fund route. Now, the issue there is a lot of investment trusts investing in small and particularly micro cap stocks. The investment trust itself trades at a very wide discount. It means that investors may be going in at one level, and suddenly during market sort of sell-offs, suddenly the discount widens. So they're not getting the full benefit of the growth in the trust itself. So again, another big disadvantage that faced by investors who want exposure to this very exciting and rapidly growing in arena.
And of course, one of the other things I think it's worth highlighting and asking you about is the fact that how do people overcome this problem about not knowing enough about individual companies? If you have a portfolio of investment across the AIM market, we're talking hundreds and hundreds of companies. How do we focus our attention on so many individual cases? Isn't it easier just to buy a fund?
It is. Of course, it's for the lazy investor, should we say, in the nicest possible way. It is easier to buy a fund, but they are losing out. A lot of funds are massively over diversified, so you see strong performance. It's some of these, for example, closed-ended fund, we've seen hold 300 plus positions. So that, again, it's over diversification for no apparent real benefit. If you're investing directly, you can construct your own diversified but better balanced portfolio. So for argument's sake, have 25 positions rather than 300. And as a direct investor, you also don't have the illiquidity reasons. The only reason these funds are having so many holdings is they're getting more and more money, and it needs to be placed into relatively illiquid stocks. So they just keep buying more and more stocks. They want exposure to a growing number of companies, but they're not. If you're holding 1% of a stock, even if it multiplies by 5, it's only going to be 5%, isn't it? Of your fund, it's just nonsense, I think. So there is a real benefit of holding directly, but admittedly, you need to do a little bit of your own work or give it to a portfolio manager to do it for you.
And of course, something else, as a portfolio manager yourself, I know you come across this a lot, as people wanting to get some sort of tax advantage, which of course is one of the really good reasons to invest in AIM stocks as well. How does this work to a benefit for a company like yours, where you do put these portfolios together? How important is that tax advantage, and what do people use it for?
Well, this is a key benefit for AIM, particularly. Aside from all the liquidity issues that we've mentioned, the liquidity constraints. If you want exposure to AIM shares and potentially to benefit from the inheritance tax benefit as well from them, you can't hold the shares in a collective. You have to hold them directly. So if you're advancing years and you want exposure to AIM and are holding collective and investment funds, it seems sensible for you not to hold them, or especially particularly if those funds are holding AIM shares, because you're losing out on that potential inheritance tax benefit, which means simply that you can make a saving, 100% inheritance tax saving, and at 40%, that's clearly pretty attractive, simply by holding the shares directly. And we see so many small cap funds, even blended small to mid cap funds, holding AIM shares, and investors would be a lot better off if they, from a tax planning perspective, if they held them directly.
Of course, there would be a big benefit should we need to call on that tax benefit at the time of death, obviously, if you're holding those shares. But what do you say to people about the comment to suggest that it costs more to hold individual stocks, and it does to go down this route where you're getting a collective investment of anything up to, like you say, 300 stocks potentially? Surely it's a lot cheaper to do it through the index route rather than individual holdings.
Not anymore. First of all, you can't. An index route isn't applicable to smaller quoted companies. There isn't, for example, a tradable AIM index, so that's clearly out of the way. And the low cost of trading through your own platform and others are such that the advantage is now is with the individual investor. I mean, it's so cheap now to buy and sell shares. Some crazy brokers are offering zero commission. It's so easy to buy and sell shares. The costs are low. Obviously, if you're doing things yourself as well, you haven't got all the extra administrative costs. I mean, we've looked at some closed-ended funds, which when you apply a performance fee, their total expense ratio, that's the quoted expense of running the fund, is over 7%. And even the lower cost micro and small cap funds are have a total expense ratio of sort of 1.5%, which is pretty high. And if even a portfolio manager is only charging 1%, and with low trading costs and the absence of custody fees, separate administrator fees, and all the other gubbins and audit fees, your costs actually now for doing it yourself via portfolio structure offered by a stockbroker or a discretionary investment manager, or indeed yourself, are an awful lot lower. So it's very compelling now. I think all we're talking about here is investment basics. The financial services community sort of loves creating complicated vehicles, a fund that invests in another fund and invests in another fund. This is really back to basics.
Okay, interesting. Look, Chris, we'll leave it there, but thanks for joining us with this tour through some of the advantages of going down the equity investment path for individual stocks rather than buying into a collective investment vehicle. That's Chris Boxall, a portfolio manager there from the portfolio management company Fundamental Asset Management. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.